I think it's better to look specifically at the causes of the inflation, there was a study a while ago showing that in a concentrated economy, so an economy where fewer firms hold more of the market power, the feed through of prices is bigger. So if those companies face an increase in energy prices, there's a bigger increase in consumer prices. So it's also the concentration in the economy, speculation, which is also causing inflations. Companies which are making high profits and because they can pass on high prices to the consumers.
Okay, so this is the price gouging argument, I think, right? And I don't know too much about this. It makes sense, I think, that you shouldn't only look at labor, but also at capital, because the Phillips curve argument that they typically use is very much a labor story. This is more a profit story, right? And you're saying this is something that economists are looking at more now, I think. And you're saying, I think that they should do that. Is that correct?
The Phillips curve is outdated. The Phillips curve doesn't hold. There's no clear trade-off between inflation and unemployment.
Yeah.
And as you say correctly, look, if input prices are rising, companies can either increase their output prices, maintain their profits, or they can decrease their profits, and there won't be inflation. So if there is a trade-off, it's not so much between employment and inflation, but between profit and inflation.
And what would be a solution then? Price controls?
A solution would be but that's a longer-term solution, to fight against concentration in the economy. There's excellent research by Jan van Eekhout, The Profit Paradox, it's called. It's a book about why profits are bad for the economy, in a very provocative title thesis. And it's because basically monopoly power. So many companies, especially large companies, of course, corporations, listed companies, are making profits, which are super profits in the sense that they could make lower profits and still be in operation and deliver the same goods and services, but they have so much market power that they can have higher profits. So we should have we already have quite a good understanding that part of the feed through of high prices into high energy prices, for instance, or high consumer prices, is because of market power, and that's what should be attacked. In the short term, it's very difficult to do that.
Could this also explain the inflation gap between Europe and the United States? Because if I remember correctly, there's much more concentration in the United States than in Europe.
It could be, yeah. It could well be, but that's an empirical issue that we would have to look into.
Yeah, so this is also something. I did a lot of inflation videos looking at all sorts of channels, demand, supply, also something I like to call demand shift, because you had this huge demand change from services to goods. But I haven't looked at this, so thank you for that at least. I will have a more careful look at this.